Welcome back. You are tuned in to Traders Nation. Thanks for staying with us. It's my pleasure to have with us Matthew Padilla. He's with us today. He's book author of Chain of Blame, How Wall Street Caused the Mortgage and Credit Crisis. Matthew, welcome to Traders Nation. How are you today?
I'm good, and I'm glad to be here.
Good, good. All right, yeah, we all know that we've got a mortgage crisis on our hands, have for a while. In fact, we called it about a year before it happened. But nonetheless, I won't get into that, Matthew.
Sure.
What caused this? Wall Street? Is it really Wall Street, or is it some, the Congress was pushed to make liberal policy, too. It said, hey, we need to get more people in the housing. Was that part of it, too? I mean, there's a lot of different reasons, isn't there?
Yeah, I mean, absolutely. The dream of American home ownership is like apple pie, and, there's always been this drive to get folks into homes almost at all costs.
Right, and that's what it almost seemed like, wasn't it? Because, let's face it, people got loans that probably shouldn't have gotten loans, and that's why we're kind of seeing what we're seeing.
Yeah, I mean, our book chronicles Wall Street got into the business in the late 70s, and then in the 1980s they went full force, and basically they took the risk off of the books of banks and made these bonds and sold those bonds around the globe. Yeah. So when you do that, banks kind of think, hey, I can do whatever I want because the loan is not on my books.
Right. Right. All right. So, and there's some other policies that were in place. For instance, you wrote about Merrill Lynch and Bear Stearns. I mean, they were using sweatshops to process some of these loans. I really don't know what to say there. These companies have a problem on getting some of these loans processed because the demand is so great. But should we be using sweatshop organizations to be processing some of these loans?
Yeah, it really boggles the mind. I guess the Wall Street firms don't like to have employees if they can avoid it. So they would hire these sweatshops. The Bohan Group and Clayton Holdings were the two largest. My co-author and I, we talked to like a dozen people who basically said they were under tremendous pressure to the point where they would be in a conference room, having to look at as many loans as quickly as possible, and some guy would stand up on a desk and say, look at more loans more quickly or you're all fired. I mean, it was just crazy stuff.
Right. I mean, it almost came down to like piecework, wasn't it? You know, they were trying to get like a loan an hour or something.
Yeah, it became a volume-driven business, like some kind of like they were selling books or iPods or something, and not not underwriting, where you actually get to know your customer and make sure the customer has the assets and income.
You're like shipping managers.
Yeah, it's crazy to think about it. But
they barcode this. Okay, that one's out the door. Next!
Yeah.
All right, let's talk about Countrywide's Friends of Angelo's. Angelo had a lot of friends, didn't he? In fact, wasn't Obama one of Angelo's friends?
Yeah, I mean, we had mentioned that in our book, almost as something we just tossed out there because it's kind of the way guys did business. But yeah, Johnson, the guy who was looking for a VP for Obama, he used to head Fannie Mae. He was a friend of Angelo and got a loan deal through him, which looked pretty good, maybe too good of a loan deal there.
Until he brought him onto
some senators. It's now come out.
Right. It looked good until he brought him on his campaign. And then all of a sudden there was an abrupt 180 and a reversal of fortune, if you will, and had to exit stage right. All right, so that's interesting. It almost reminds me of the days Friends of Angelo. Reminds me of Friends of Bill. Remember FOB?
Yeah.
Everybody, Friends of Bill. Anyways, nonetheless, let's move on. All right, so there was a lot of Wall Street firms, reputable Wall Street firms. It was like a gold rush, wasn't it? I mean, you got this euphoria going on during this era, and so it's pretty tempting.
I mean, yes. Bear Stearns and Lehman Brothers were two of the earliest who had subprime shops back in the 90s and just went to town after Greenspan cut interest rates. But then it was just, it boggles the mind because in 2006 I was writing stories about the subprime miracle gone bad.
Right.
But in late 2007, a whole year later, Merrill Lynch, who's the blue chip stock company, spent like $1 billion or more actually for a subprime lender called First Franklin, and what was Stan O'Neill, the CEO, thinking? The game was over by then, but Wall Street it couldn't admit to itself that this golden egg was this goose was dead.
Well, let me ask you something, because let's face it, some people think profit is a dirty word. God forbid you actually make money, you know. So what's so bad about wanting to make money? You make it when you can, because there's other areas, maybe in a larger corporation, they have divisions that lose money, and you got to make it up somewhere, right? But it's not such a bad thing to make a profit, is it?
No, profit's good. Efficiency is good. But, I mean, when you think of companies that have been around for a long time, like, I don't know, General Mills or
I love my
IBM,
Cheerios.
They have a long-term view. It's when Wall Street takes over and has this short-term, let's just make profit on the trade today and not worry about tomorrow.
It's like scalping a market instead of scalping a trade, right?
Yeah, exactly.
All right. So there you have it. So what do we learn from all of this? What's the one thing that really stands out in chain of blame that you would want everybody to know about?
Well, I think what people have to keep in mind is that when you deregulate markets totally, like in 1999, Bill Clinton tore down the Glass-Steagall Act, which had walls that separated banks from investment banks, and it's been a free-for-all. These mortgage companies that don't take deposits from consumers have been in an unregulated world almost.
Sure.
You can't leave certain markets unregulated. You need to have sensible controls.
Sure.
And so I think that's we don't want to see Congress make dumb new rules that makes it harder for the average guy with good credit to get a home loan.
Well, let's touch on that, because the average guy with good credit that made the right decision in the end is going to end up having to pay for this. Should we bail out people that made bad decisions? That's a big question mark, isn't it?
Yeah, it is. And when I talk to folks, there's so much frustration about, hey, I saved my money, I rented, let's say, and I've been waiting to buy a home.
Sure.
I mean, all the tax breaks go to the homeowner in terms of interest rate deductions, et cetera.
Right.
So capital gains too.
Right.
So if you're a renter and you've been saving money, and now your tax dollars will go to bail out some.
That's right, and that's the other thing too. Not only did they wait, maybe these guys were playing it smart and they're waiting, and now they've saved their money up, but because of credit so tight and lending policies are just suffocating, they may not be able to get in now. Now that they're ready, they can't get in.
Yeah, it is brutal. I mean, but at the same time, I think prices will keep going down because of all these foreclosures.
The guy's sitting there going,
if you've been saving your money, next year, or I mean, I'm sorry, you may have to wait longer, but you will get a deal now and next year.
Right. So the guy's going, I was playing it right. I was playing by the rules, and now here I go, and the pooch is running from me. All right. So let's talk about the subprime lending. At some point, it got very liberal. What happened there? How did it all get started?
Well, I'll try to give the short version. Thrifts kind of failed. Savings and loans, S&Ls, in the late 80s, early 90s. Wall Street took over this business of funding loans, and they found that they could make more money with subprime. The whole system was it was like this chain. The mortgage broker who got a piece of the pie actually earned more money by doing a subprime loan. Then the broker turns that loan over to Countrywide or some other firm, which gets like a big pool of loans and sell those to Wall Street. So that bank earned money, and then Wall Street gets like $1 billion worth of these loans and sells them as bonds all around the world, and gets its money. And hopefully the investor was supposed to make money, but apparently a lot of those loans are going bad, so investors are taking hits. So I mean, it was a food chain that made a lot of sense, but they kind of ran out of good, ideal. I mean, there's only so many people with bad credit, but a lot of equity in their homes.
Right.
So they would accept less and less equity, and by 2004 or 5, you could actually get 2 loans where one loan was your down payment, and you didn't have to get mortgage insurance.
Right.
That's how crazy it was. I mean, just someone with bad credit doing that, it really makes no sense.
It doesn't make any sense. And, I hate to say it, I really don't want Congress to get involved because the government can't run a good business. They've been proven to just simply can't run a good business. I think the industry, once again, should we depend on an industry to self-regulate itself?
I mean, we can't. I mean, not this industry. It's been completely unwilling to self-regulate in the way that maybe you have strong trade groups in medical or law. So I think we need to step in and make put back up some of those.
Maybe it
walls
should be part of a licensing procedure or something to that.
That
they have to adhere to a licensing procedure.
Of mortgage brokers, for example.
Yeah.
Where you just, you have to do more training in some states to be a barber, to cut someone's hair, or to be a stockbroker when maybe you're handling 10 grand.
No wonder my barber always tries to sell me real estate when I go there. We got less than a minute left. Cyclical pattern. How far out are we looking for this to die out, level off, dust settled, and then come back again? You're right. You're thinking maybe a decade.
Yeah, we take the dark view because the way that we fund home loans in America is broken.
Yeah.
Plus we have a record foreclosure. But maybe it won't be a decade. Maybe we'll bottom in 3. Wall Street will start buying loans again, and 7 to 10 is
7 to 10. All right, we gotta hang out. We gotta hang loose and ride the storm. Chain of Blame is the name of the book, and today we got Matthew Padilla. He's with us today. Now, Matthew, where can we find the book at?
You can go to Amazon.com or our own website, chainofblame.com.
Head on over there today, Matthew. Thanks for being with us. Stay tuned. We'll be right back.